You
Good to
doing,
see you
buddy?
guys too. Finally.
Yeah.
Yeah.
How you been?
Good. Enjoying
Good.
the home. Thanks. Moving mortgage. I
How's
think
the place? The place still treating you good?
yes, so far so good.
Perfect.
Commute is pain in the sometimes, but it's just
Yeah, it's
changing.
the
Yeah,
cost
I
of
mean,
Yeah.
Matter what, man,
yeah.
you're never gonna get away from that commute, right?
Cost of owning a home.
It's
Right.
all right. It's all right. We'll change schools in a little bit for the
Oh,
next school
cool.
year, but yeah, it's
It's
good.
nice.
Thanks.
So I got us. We're live. We're on the air, you guys. Streaming live on YouTube. So today wanted to go over our mortgage masterclass and really Matt and I have been teaching this for, I mean, I've been doing this for a little bit longer than Matt. You've been doing this what, 4 years now? And I have been teaching this for like
Crazy.
7 or 8 years, you guys. So we do this every so often. We usually wait until newer folks join us so that they can learn some of the mortgage ins and outs. And it's always good to come back and get a refresher as well because our rules are constantly changing. And evolving and limits are changing. Like for instance, right? Like I even started by updating this whole thing this morning, and the very first number is the one that I didn't update. So to get started, y'all, understand that there's so many different types of mortgages out there, right? Tons and tons, like literally like well over 100 different types of mortgages. Like we offer upwards in the 60s, I think it was like 63, 64 different types of loans the last time I counted. So it's a lot, right? But the majority of loans kind of fall into the common parameters, and that's what we're going to go over today. So we are going to be talking about conventional loans. We're going to be talking about FHA loans and VA loans, right? And so that's probably where about, I would say, 90 to 95% of all loans kind of fit into that basket, right? So 9 out of 10 times, you'll be able to use one of these loans in order to help your clients out. And so you'll at least know and be able to scratch the surface and ask them questions, and we'll go over the questions you should be asking to really understand like is really are they going to qualify for a loan? Like even like rudimentary, like very high level information. So for instance, let's start with loan limits. Okay, loan limits. What does that mean? So there's entities out there called FHA, right? The Federal Housing Authority, the VA, and you have FHFA, right, which is the Federal Housing Authority as well, and then you have Freddie Mac and Fannie Mae, and they set these guidelines every year. They change the loan limits. So they say that you can borrow up to $766,550 and still be in a conventional conforming loan. And what does that mean? They put out the guidelines that most banks follow, right? And we're going to go over these guidelines in depth. So as long as you're within those, underneath that number for a loan, you can get a loan pretty simply with as little as 3% down, right? When you go a little bit over that number from 766, 550, all the way up to now in San Diego, you guys, it's $1,006,250. That's still a conventional loan. It's just a high balance loan at this point. Okay. And so there's different loan limits in different counties. I want you guys to understand, like if you cross the border and you head into Riverside County, you do not have these high balance loan limits. They don't exist up there. So you're limited to the 766, 550. Okay. Anything over that 1,600,000 is gonna be considered a jumbo loan. And we will teach a totally separate class on jumbos. It is a totally different animal. It's a lot harder to qualify for jumbo loans. They look deeper into your income. They, analyze it, especially if you're self-employed. They make you have reserves. There's all sorts of rules for like first-time home buyers and investment properties and second homes. And it's just, they become much more complicated. So there's a whole separate class on jumbo loans, but just want you to know anything over that million, 6,200, $250, you were talking about you're talking about a jumbo loan. All right. So here's your conforming loan limits depending on how many units, right? So if it's a single unit home, you're at that 766, 550 for a conforming loan limit. You can put 3% down to buy that place. If you go over that and stay under the million, 6, you need 5% down for that high balance loan. Okay. So, one of the things to ask your clients is like, hey, have you been saving money for a down payment? Oh, you haven't? Okay, great. Well, how do we plan on coming up with that money? There are down payment assistance programs, which we're going to teach a separate class on that. Actually, I'm going to be teaching 2 classes this week with Alicia's team. If any of you guys are on there, I'll be teaching that tomorrow night and then Thursday afternoon on the Dream for All program, which I'm sure you guys have heard of. Not going to get into it right now, but there are down payment assistance programs that can help clients. But understand that there's a lot smaller buckets of people that qualify for those, and there's very strict guidelines for people to be able to get that money. And so we need to be able to really dive into it. So if somebody's telling you like I haven't saved any money for a down payment, you know that they're gonna need to talk to one of us, Matt or I, like ASAP, in order to figure out like what can we actually do? Like, what kind of loan can I actually get? Like, what can I qualify for? Right. We don't want you guys wasting your time going and speaking to people that have no business borrowing money. So make sure that like the first thing you ask them, have you had any credit issues recently? Right. So like, let's dive into like conventional loans, for instance. The majority of these loans are going to come across conventional. So FICO scores for them, you need a 620. So what are we going to evaluate when somebody applies for a loan? You guys, there's 3 C's. There's credit, there's collateral, and there's capacity to pay back the loan, right? That's what an underwriter is going to look at. And an underwriter is a person that works for the bank that actually makes a decision whether or not to lend you money and how much to lend you, right? So credit easy. It's a hurdle that we have to overcome, right? So 620, we got that credit score, great. We can apply for the loan. We can qualify for a conventional loan. However, the parameters as to how much you can qualify for will depend on how high of a score you have. It will also depend on your capacity to pay back the loan, right? And by capacity, I mean how much money are you making, right, that you can afford to pay back this loan. So we look at what's called a debt to income ratio, and that debt to income ratio drives your purchasing power. So you can have up to 50% for a conventional loan in debt to income, which means that half of all your gross income, right, will help you qualify for that loan. But that half, right? But you half of then you have to subtract all your debts, right? So that half is all your debts that we pulled in from your credit score divided by your gross income, and that 50%, you can only get it if you have good credit, really good credit nowadays, right? And you have good stability on your job, and you're making your payments on your credit cards, and you're making your payments on your student loans and your cars. Because if you have something in the 600s, they're going to lower that number. The algorithms behind the scenes, when we click on our automated underwriting system, right? Those are going to change the parameters. So they'll drop it down to 47%, sometimes 45. I've seen them, Matt, I think 39% was one of the lowest ones that we've seen recently.
Yeah, it's being really finicky. That 50% is getting farther and farther in between. 47% is kind of the benchmark now to really get them accepted in our automated system, a couple to close to 50, but it's really getting squeezed down because of credit incidences, even with higher balances on credit cards, not because it was a delinquency or anything like that. So yeah, the algorithms are really tightening the screws behind the scenes for sure.
They definitely are, you guys. So your credit, right? You get the credit. When you pull our credit, we get all your monthly debts. We add the house to it, right? So we have the housing payment and we have the total debt payment under 50%. And then, like I said, right from the beginning, collateral. Do you have money for a down payment, right? And that's what that last C is about. And so it's really important to kind of ask them kind of from a big picture standpoint, like, hey, do you have you had any credit events recently? Have you had any issues with your credit? Do you make your payments on time? No, my payments are great. Like I'm in 700s, blah, blah, blah. Awesome. All right. Have you been on your job for a while? Because you need at least 2 years of work history, unless you just got out of school and got a job, or you just got out of the military and got a job, right? You need 2 years of work history. So if that's the case, you really want to know, like, okay, great. Are they working at Walmart? Or are they like, do they have like a substantial job where they're making a significant amount of money? Because you guys, you need to make $10,000 a month here in San Diego to buy a $500,000 condo. Let that sink in for half a second, right? If you're working at Walmart, you're not making $10,000 a month. I don't care how much overtime you put in. It ain't happening. So I want you guys asking these questions because I want you guys to be super smooth in your conversations and understand that, hey, there are some people that just are not going to be able to buy a house here in San Diego. It just is what it is, right? And I don't want you guys wasting your time on that because it's going to be very, very difficult. Look, if you go to Ashley Stats meetings and you take a look at the available properties that are under 500,000, it's a couple handfuls. Like, there's really not a lot. So we really need to dive deep if someone's telling you that they're working part-time or they don't have like a really decent job making a good living to buy a house. It's going to be hard, right? So keep that in the back of your mind. You got your down payments requirements. They only need 3%, you guys. So I mean, look at, you buy a $500,000 condo, it's $15,000 you need for a down payment, right? If you're staying under the conforming loan limit. 5% if you're going into the high balance, 15% if you're buying a 2-unit property, a duplex, right? And then 25% if you're buying a 3 or 4 unit. So you like house hacking, you hear all these stories about people going in and buying these homes and like renting everything out and letting the rents pay for it. Really hard to accomplish with a conventional loan if you don't have any money. One way to do it, we're going to dive into FHA loans here in a minute. But if you do move into one of the 3 or 4 units, you can have the other units try to help you qualify for the home. However, with FHA, there's called what's a net tangible rule, right? And so if the other properties don't pay for the whole mortgage payment, it won't fly with FHA. Which is one of the things that people that do house hacking, those little like 30-second quick posts on Instagram and stuff like that, they don't tell you about. But there are rules that prevent it from happening. You may wind up finding these properties elsewhere, but in San Diego, a 3 or 4 unit is probably going to be too expensive for the other few units to be able to cover that monthly payment. So a second home, you need 10% down, you guys. Bare minimum, 10%. And investment properties, 15% for a single unit. You need a 25% if you're going to buy a multi-unit. And that's across the board. Questions so far? Anybody? Oh, cool. I'll keep flying through this. Make sure you guys understand everything. If anybody has any questions, just stop me. So credit waiting period, y'all. If you do have any credit events in your life, you had a short sale in the past, you had a foreclosure, you had to file bankruptcies, they require, and by they I say Freddie Mac and Fannie Mae, require you to wait a little while to reestablish your credit in order to purchase a home again, because they want to make sure that you can get a hold of your debts that already exist, and they want to make sure that you can, before you start taking on a new massive debt, because let's be honest, a house is going to be the biggest debt you're ever going to have. It's also going to be your biggest asset that you're ever going to own. So they do have waiting periods. They're listed right there: 4 years for short sales, 7 years for foreclosures, 4 years for BKs, 2 years for Chapter 13, 4 for Chapter 7. So there are ones with shorter waiting periods. We'll get into that in a second with FHA and VA. But for conventional loans, where you can put 20% down and not have any mortgage insurance, that is your waiting period. So let's see. Mortgage insurance, you guys. People have heard of mortgage insurance. What is it? It insures the bank. Like, you're paying for insurance because you don't have enough money to put down onto the house that you're buying, to make sure that you don't just walk away, right? So that insurance will cover any kind of differences that the house may have when the bank goes to sell it. Right. So for instance, you buy a home, you lose your job, you can't afford the payments, prices of housing came down, right? And now the house is a little bit underwater, right? So now what's going to happen is the bank is going to sell that house and there's going to be a difference, and that mortgage insurance will cover that difference of what that house is. And that's really what mortgage insurance is all about. The rate for conventional loans it's got so many different variables that go into it. So it really depends on like what type of purchase you're doing, right? So if you're buying a first home or you're buying a second home, a primary residence or a second home, depends on your credit. If you have poor credit, it's going to be higher. If you have great credit, it's going to be lower. If you put 5% down versus 15%, you're going to have different payments. So it's different for everybody and every single scenario. So we have to run this. It's not just like a flat number across the board. And there's a bunch of different companies that do it. So we can shop around for the least expensive one, but we do need to put all these parameters into a formula, and then it'll spit out that number for us. So you can petition to remove that mortgage insurance. So mind you, that mortgage insurance stays with this loan until you reach 22% equity on the house, right? That's right down here. But you have to like ask for it to be removed. Right. You take an appraisal, you pay for an appraisal to get done, and you send it in, and you can have them remove it. Now, between the first 2 years, it's mandatory. You have to have it, right? From years 2 to 5, you can, as long as you have 25% of equity, and amazingly enough, like a lot of people built up 25% of equity over the last 3-4 years, right? So a lot of them we're reaching out to and we're like, hey, let's get your mortgage insurance removed. You don't need to refinance. You just need to get an appraisal done. And we submit that appraiser to the servicing department, and then they will petition, and then you ask them, say, hey, my property is worth way more than what I bought it for. I've done this work. I've done that work. It's appreciated naturally. Please remove my mortgage insurance. And they do that. And so your payment will go down naturally just by getting rid of your mortgage insurance, right? If you put the 20% down originally, you're not going to have it. But anyone that puts less is going to have some amount of mortgage insurance that's built into their mortgage payment every month, right? So anything from 2 to 5 years, you have 25%. Over 5 years, 22%. Okay. And that's equity in the house. So, and what's equity? Just in case you guys don't know, that's the difference between what the house is worth and what you owe in the house. That's how much equity you have. So if there's 25% of equity for the value of the house, say your house is worth $1 million and you only owe $750, there's your 25%. You send in an appraisal, you get it removed. Cool. Makes sense. This is the only one that mortgage insurance pertains to when it comes to these type of nuances. It's pretty straightforward with FHA, and then VA does not have mortgage insurance. And we'll hit that in a sec. Condos, you guys, if you're going to be looking at a condo, they all have little nuances to them that are really important for you to understand. And so don't go diving into every single condo being like, yeah, we can absolutely afford this, not a problem. Look, there's a difference between the condos and manufactured homes, okay, and mobile homes. So manufactured homes are even more complicated. They're very, very hard to find here in San Diego that don't have leased land. We don't do leased lands. There are a handful maybe of credit unions out there that might touch leased land, but you have to own the land to do a conventional or an FHA loan or a VA loan for manufactured homes. You do not, but leased lands, like we don't. This is very, very risky, because what can happen is somebody can decide to sell that land that those mobile homes are on, and then you got to get rid of those homes. I've seen it happen down at Bay Park when I used to live down there. There's a huge mobile home park down there. And one day, out of the blue, the owner of that property sold it to a developer. They gave everybody 90 days to get out. And those that didn't, they came in with bulldozers and took their houses down and cleared that pathway out. And they put all new nice construction out there. So please keep in mind, lease land. If somebody's coming to you and being like, I want to buy something in San Diego, I found this manufactured home, I found this mobile home. It's not the best investment in the whole wide world. It's not like buying real estate, because you don't actually own that land. You might own a box on top of the land, but you don't own that land. So please be careful and warn your clients if they are trying to buy something like that. It's not usually worth it. Condos, on the other hand, are condominiums. They do have separate rules. Fannie Mae, for instance, does have owner-occupied rules, right? Excuse me, that it pertains only to investment properties. If you have an investor going out there buying a unit that he plans on renting out, doesn't plan on living in ever, right? There are guidelines that say it has to be 51% owner occupied. But for some reason, big myth across our entire industry is that no matter what, that condo complex has to be 51% owner occupied. That's not true, you guys. That may be a rule that certain banks put into play. If you are buying an owner occupied property in a condo complex, they want you to own, like, they want more owner occupants. Why? Because they care more about their properties, right? Like you live there, you want your community to be nice. You're going to take care of it. You're going to pay your HOAs. You're going to, be mindful of your neighbors and so forth. So they want more owner occupants, not as many investors. Investors, that's the first thing they walk away from. Like in a downturn in the market, they're going to let their investment condos go. That's the first thing that happens, right? You'll see it in any recession. Those are the first to become available. So there are no owner occupant requirements if you are buying an owner occupant unit. There are a couple more little nuances to look for. If you're going to be looking at a condo complex, especially if you're going to be taking a listing, you're going to want to call that HOA company, ask them, hey, does anybody own more than 20% of this complex? Because you can sometimes have a 10-unit complex and somebody can own 3 or 4 units. I've seen it plenty of times. I've seen a place up in Del Mar where the original developer still owns like 70% of the entire complex. And I mean, there's over 100 units and the developer still owns the majority of it. It's very hard to get financing, if at all. Definitely not conventional if somebody owns 40, 50%, because think about it, right? And here's kind of the thought process behind that. If that one person dies and 30, 40, 50% of the HOA income stops coming in, how are they going to pay their bills? They're not going to be able to. So it's really important that you ask that question when you call the HOA company, if you get your listing in a condo, right? Your budgets, you got to have 15% of reserves. Why is that important? Because things happen in HOAs. Things need to get fixed. And if you don't have money sitting in the reserves, you're not going to be able to fix them. So if they don't, it could disqualify that entire complex from getting conventional financing. And again, we kind of touched on that original one that if an investment is being bought, it's got to be 51%. Another one is that there can't be any construction defect litigation, right? So if a place was built and it's being sued now by the developer is being sued by the HOA because they put in, cheap copper piping throughout an entire building, and it's got much more potential of leaking. They didn't follow code. They can get sued and you're hung up in this lawsuit for years on end. You can't sell your place because you can't get financing in that, right? So now Fannie Mae has kind of upped the game even a little bit more. I haven't put it on this because it's kind of too many intricacies to it. But so now if you have special assessments on your HOA, and what special assessments are, so for instance, you have like overhangs, right? And walkways, and balconies that connect properties, right? And those have had deferred maintenance. And all of a sudden, like, they have a special assessment of like $200,000 to fix all this stuff, which means that everybody's got to chip in like a few $1,000, or depending on how many units, right? They have to chip in extra money above and beyond their monthly HOA payment to fix all these things that the special assessment is all about. Now Fannie Mae just changed their guidelines a couple of months ago that says that they won't lend in that property until that special assessment is completed, whatever that special assessment was for. So now we need to get that documentation to make sure, is this a health and safety issue, or is it a special assessment that really isn't going to impact the livability and safety of the residents, right? I just had one that came up and we can't do a loan in there because of this new rule that's come into play. And that's going to be across the board for anybody that does conventional loans. Lastly, there's for conventional loans, there's what's called home style renovation loans, right? You can actually put in to your loan whatever kind of renovations that you want to do up front. And we can build that into the loan. I've got a separate class on renovation loans that we did last year. And we can do it again. And just going over them because there's a lot of information on renovation loans, but I just want you to know, for instance, if you buy a $500,000, $600,000 home, right, you can put up to the difference in that conforming loan limit. You can get up to that difference built into your actual loan when you purchase the house up front. You would just need to get a contractor to go out there and give you the specs so that we can take those specs and hand it to the appraiser. And then he goes out there and that appraiser does an as if appraisal, as if this property was already built out this way. They're going to find comps with the similar bits and pieces that were done, right? There's similar renovations that were completed, and they're going to comp it out differently than they would just as is. So the loan exists. I want you guys to know that. So if you do go in there looking at a house, looking at, that needs a little bit of TLC, we can help the clients kind of fix it up when they're buying it in advance. So if they don't have the money to do it, they shouldn't shy away from the house just because it needs a little love and care. We can get around to fixing it for them. Well, the contractor will fix it. We'll help them get the money for it. Questions, y'all?
And it just doesn't need to be a little bit of TLC. It could be a lot of bit of TLC.
Yeah.
If there's an opportunity for financing for a home, which would rather have not been financeable because of the condition it's in, let us know. We'll take a look at it. We'll get somebody in there for sure.
Quick question, Eddie.
Yeah.
Whoever. So this is probably a dumb question, but how do you know like what loan to use? Like if just like in a general basis, if someone's like wanting to buy a house, like how would you know which loan, they might qualify for and stuff?
Yeah, no, that's a great question, man. So again, it's going to come back to the 3 C's, right? Your credit, your collateral, and your capacity to pay back the loan. First thing we do when we get an application, right? And don't worry about it. It's never your job to determine what kind of loan that they use. That's what we do. We figure out what bucket to use, and we get really creative sometimes. Like if they're really complicated loans, we can get creative. But we look at the 3 C's, right? We run their credit. That's the first thing we do. Click a few buttons, boom, we get their credit score. That credit score will determine whether or not we're going jumbo, conventional, or we have to go FHA. So FHA we're about to dive into came about in 1938 for a reason, right? The government came out with the Federal Housing Authority to help credit challenge people that were going through the Great Depression, right? And whose credit got destroyed, decimated because of the times that they were living in. So FHA has lower credit standards. Okay. You can go down to 580, right? With a FHA loan. They still have the same loan limit, right? And they only require a 3.5% down payment. So, and again, if they don't have any money, we can take a look at some of the down payment assistance programs out there. The down payment assistance programs do have a higher FICO score requirement, but they do provide an assistance to make up for that 3.5%, and they can even contribute to some down payment, some closing cost assistance as well on top of that. So you can actually piggyback like 3 different loans, and one for your main loan to purchase a house, one for your down payment assistance to cover the down payment, and one to help you out with the closing costs, right? So there are ways of doing this. Not exactly ideal here in San Diego. It's a little bit harder to find homes and to find somebody that's willing to take on a client or accept an offer when you're coming in and you got no money and you're up against everybody like has a lot more solid of a financing position coming in with an offer, right? So it's just harder to find a property, to buy. It makes it much harder. But there are options out there. But we look at the 3 C's, man. Credit, we run the credit. That'll send us one way or another. We'll take a look at the collateral. How much money do we have to, put down for the down payment? And then we'll take a look at their capacity to pay back the loan. And that capacity is going to drive that purchasing power, right? That, like, they make $10,000, we can use $5,000 towards all their debts. They make $20,000 a month, we can use 10 grand towards all their debts, right? Maximum, absolute maximum, right? For one of these different types of loans. So FHA goes a little bit higher. We can actually get up to 55% debt to income. But again, you need compensating factors to be able to push the debt to income.
Got it.
There's algorithms in the back end of these underwriting systems, right? And they manipulate them depending on how the economy is going, right? And right now, we're in a very tight monetary policy economy. So banks are not as willing to lend, even though you would think that they would because they're getting a much higher interest rate, right? But it's still, it's expensive for them. And they know that these loans are going to get refinanced. And so banks don't make money in the short term by making a loan. They make money in the long term by holding that loan. And so they don't necessarily want to, they're not really enticed to make loans right now.
Got it. Okay.
Yeah.
Well, and like short answer, easy answer is every time we get an application, we start at conventional and go from there. The more complicated it gets, the bigger and deeper into the basket of loans we got to go into. But we always start at conventional if we can, because A, it's the easiest, least red tape, easiest to get approval for. But if we have to start digging into the box, we start digging into the box.
Got it. Cool.
Yeah, we can close a conventional loan in 8 days.
Wow.
So you guys are up against cash offers at that point.
Okay. Cool.
FHA takes a little bit longer because the appraisals sometimes take a little bit. Same with VA. So they could take up to 10, 14 days.
Okay. Cool.
But yeah, VA sometimes 16, 17 days because the appraiser is given 14 days to get you that report back by VA guidelines. So we can't mess with that. We can't even reach out to the appraiser on a VA loan.
Got it. Cool. Thank you.
Yeah. Hopefully that gives you the long and the short.
Yeah. Yeah, it's good.
Cool, man. So FICO scores, like I said, FHA is a little bit lower, a little bit higher if you're going to go into that high balance arena. You need that 620. 3.5% down payment. Don't forget, you guys, each county has its different loan limits. So you cross over into Riverside, it's not going to be $1.6 million. It's still $766,250.
And for FHA, check that out. For FHA in Riverside County, it might be a little bit lower than the actual conforming loan limit.
Yeah, it's weird. Riverside does it weird. True story. So we have to check that out no matter what, every time. It has to be owner occupied, you guys, with an FHA loan. You can't buy an investment property. And that's why I said, like, you could buy a multifamily using 3.5% down payment. I did it when I was 24. Like, that's one of the first things I did. I got out of college and we bought me and my best friend bought a 4-family, 3.5% down. We moved into the place and just started flipping it. And we literally started tearing down the walls in our unit, and our friends moved in. We rented it all out. It was a lot of fun. It was a big party house, not gonna lie. But it was, we doubled the value of the house in 3 years, 2 years. So it was pretty incredible. It is an opportunity, just probably not around here. Buying a 4-family around here, you're talking a couple $1 million easy. So it does have to be owner occupied. Short sales and foreclosures, again, all these waiting periods are going to be shorter with an FHA. So again, to answer your question, depending on, like, if you have credit issues in the past, we might have to go FHA. It's going to drive the conversation one way or another. Same with bankruptcies. It's half the time, so 2 years, not 4 years. Foreclosures, conventional is 7, here is 3. So, you know, depending on their credit history, will determine which direction we head in. So mortgage insurance is a little bit more straightforward, you guys. So there is upfront mortgage insurance with FHA loans. They don't have that with conventional loans. Another benefit why we would rather have a conventional product rather than a FHA product, because you're adding almost 2% of that loan amount up front on an FHA loans. And what happens to all that money? It all goes into one big bank account. And again, when people default on their loans, and they do default on their loans, that money is used to pay off their loans. and to make the bank whole. And so because there's insurance on these properties, the rates are a little bit less. There's a little bit less risk to the bank, right? So with FHA, they collect 1.75. With VA, there's a little bit of a grid that you have to look at, depending on if it's your first time or a subsequent use. They'll collect money up front. It's all financed. You don't have to come up with this money in cash, but they do have all this money sitting in a bank account. And because it's insured with the FHA, your rates are usually anywhere from 1/4 to 0.5% less than conventional, right? And then, so from a monthly standpoint, it also might be better than a conventional. So we do the analysis, right? If it's kind of on the borderline, like they're in the 600s and they're getting really high mortgage insurance with a conventional loan, and we know they're going to refinance anyways, sometimes it might make sense just to go FHA. And we'll do the analysis. We'll crunch the numbers to figure out which is the least expensive way of them financing that house. Because from a monthly standpoint, if they're only putting 3.5% down, it's 0.55%. If they have lousy credit on a conventional, and I'm talking like a 650, 640 credit score, you can see upwards of 3% for mortgage insurance on a conventional loan. And the numbers are astronomical. Like, you're looking at a $700,000, house or a condo with 3% mortgage insurance. It's like $400 or $500 additional, whereas it's going to be fixed with an FHA. So it really is all going to depend on that person's unique financial profile, which direction we head in. Mortgage insurance is permanent on these loans unless they put 10% down. If they put 10% down, it sticks with an FHA loan for 11 years. The thing is that if you got 10%, you're probably not going FHA. You're probably going to go conventional. So again, it's part of our evaluation of the actual overall profile. With FHAs, properties must be in good condition. Good, I mean, so if you're walking in, there's a railing, that railing can't be wobbly. The fence in the backyard can't be leaning like it's going to fall and crush somebody. If you have cobblestones walking up into the property, you can't have one that's raised. That could be a trip hazard. You go into the house and you have exposed wiring coming out of a socket somewhere, that can't happen, right? So they look at health and safety issues. They also look at termite damage, right? If you have a termite report. Now, they're not mandatory at FHAs anymore, but if you ask for one, they're gonna want to see the report and they're gonna want it fixed, right? So make sure you're asking them on separately and not part of the having you're doing the repairs in your RRRs. You're not doing them in you're not asking for it in the contract, because if it's in the contract, they're going to require it to be completed before we close. So also another funky rule is that you can't have flips for 90 days with FHA. You have to wait until the 91st day to write that off. So there's a lot of properties out there being flipped. You walk in and it it looks brand new. If you have an FHA client, which you should know whether or not they're using FHA because you're talking to your lender partner, they can't write an offer on there until it's been on the market for 90 days. Oh, sorry. Until they owned it for 90 days, not on the market. My bad. Matt?
Yeah, there's some jumbo loans too. There's some funky nuances with flips. So definitely do your research when you're looking into if the property looks like a flip, and the financing that goes along with those, for sure. Yeah, we ran into one that was flipped 3 times within 120 days. So
exchange hands.
Right.
3 times, right? So
exchange hands.
Right. It wasn't necessarily flipped, but you had a wholesale company buy it. They passed it off to one LLC who passed it off to another LLC, and you could see it in the chain of title, and it goes off of that last exchange. You have to wait 90 days from that. So just keep in mind.
Yeah, definitely different nuances on that.
Yeah. Condos, FHA's got their own rules for condos, you guys. And they have to be FHA approved. If they're not approved, you can't do an FHA loan on them. and there's a website. It's a .gov website, y'all, right? .gov. It's not like a FHA approved condos.com. It's a .gov email. Just make sure you guys like reach out to us. Okay, if you have any questions, and you want help, just hit us up and be like, hey, is this one FHA approved? And we'll look it up. VA has the same nuances. There's a separate website for VAs that you have to like review them to make sure that they're VA approved. With FHA, we can get a spot approval for one unit if they are in good standings. So it does cost money to do that. So we do want to make sure that these clients are serious about buying in that particular property. But don't hesitate if they're not FHA approved. Still reach out to us because we can request an exception from FHA. And also, you guys, there is part of having, yeah, sorry, I skipped this part, but part of having is it's got to be 51% owner occupant. So the FHA wants more owner occupants living in these condo complexes. We can't get it approved if it's not 51%. So, and a lot of complexes aren't. So that's why spot approval can happen, because if the whole complex isn't and they are having an owner occupant move in, they want to see more owner occupants, so they may just approve that extra person moving in. So just keep that in mind. Also, just like the home style for conventional loans, there are renovation loans called 203Ks that you can do for FHA loans. So it's awesome, man. If you guys have somebody, don't shy away from a house that needs some love. It's a good opportunity to build equity quickly and make it your own, all at the same time. So questions? I know I'm kind of flying through a lot of this. VA is the last one, y'all. And this is one of the most common ones that we have around here, to be honest with you. There's almost 200,000 active duty military members in San Diego County, between the military, the Marines up in Camp Pendleton, and MCAS Miramar, and the Navy down on 32nd Street in North Island. There's a lot of military members around us. So these are really important little facts to know. Okay. So to begin with, several years ago, they did away with loan limits on VA loans. So there is no more loan limit. We limit them up to $2.5 million. 100% finance. No down payment requirement. It's one of their benefits that they receive for putting their lives on the line for us. And, and very well deserved. So 100% financing. Now, please keep in mind that even if there's no down payment, there is still closing costs. There are still title companies that need to get paid, and a bank that needs to be paid, and escrow, and a notary, and all these other hands in the cookie jar. Right? They all need to get paid. These are part of their closing costs. Now, typically, what I tell clients is, from a conventional standpoint, it's usually 2 to 3% of the purchase price. From a VA standpoint, it's usually 1.5 to 2%. It's a little bit less. So it's not as expensive. So if you're buying, $800,000 home, you can expect somewhere between 12 to 16,000. A lot of it has to do with taxes and insurance, right? That they have to pay up front. And that's something that I didn't touch on to begin with. But normally, when you don't put that 20% down on a conventional loan, right, you have to have an impound account. Now, what's an impound account? They collect 1/12 of your annual taxes, and they collect 1/12 of your annual insurance in your monthly payment. And you have to make those payments as called your PITI payment, PITI, principal, interest, taxes, insurance, right? You have to make that payment. FHA loans, VA loans, and if you don't put 20% down on a conventional loan, you're making a PITI payment. You have the opportunity to make your own insurance payment and your own tax payments with a conventional loan, separate from your mortgage payment, if you put 20% down on that conventional. Otherwise, it's all inclusive, right? So they have to, part of their taxes, part of their insurance, it's all being collected up front. we create a huge breakdown for our clients and make sure that they are very familiar with all their numbers. When they go to purchase it and they get approved, we go over all these closing costs with them and make sure that they educate them. And I think I went over that last time when we did the mortgage coach, but we use that software to really educate our clients and make sure we do a deep dive into their particular numbers. It's really important that, like, you can't have a client. I just spoke to somebody yesterday and I was like, he's like, oh yeah, I'm pre-approved up to 850. I was like, oh, cool. I'm like, are you comfortable with your monthly payment? And he's like, what do you mean? I'm like, well, do you know what the monthly payment is on an 850 VA loan here in San Diego? He's like, no. I'm like, so you got pre-approved, you're out there making offers and you don't know what your payments are? You want to talk about the number one reason why people fall out of escrow? Because they have a shitty loan officer that never went over their payments with them. And they go and they know that the maximum they get approved for, and then they get into escrow and they get that disclosure form saying your payments are going to be, $5,000-$6,000 a month. And they're like, whoa, I can't afford that. And guess who bails? And guess who wasted their time showing them those properties and needs to start all over and go back to the drawing board because you never asked them what they were comfortable with from a monthly standpoint, right? And that's something that we do. And it's really important to us that we keep people in their comfort zone. And even if they stretch out a little bit of their comfort zone into their pre-approval, and we keep them in the pre-approval zone, we want to make sure that they understand their payments will come down in the future, and we go over that with them, and we make sure that they see what their payments will look like. But it's really important for them to understand all these figures. So, back to VA loans. Sorry, squirrel got sidelined. So you can have more than one VA loan at a time, you guys. I've had a client that's moved over here from Jacksonville, Florida, had a place out there for $175,000 and was able to buy a $700,000 unit here. Again, it depends on how much they use of their eligibility the first time. If they use most of it, there may be less left. So there is a calculation that we have to do in order to figure out how much eligibility they have left to use their VA loan for a second time, but they can use it twice. 3 times, 4 times. They can keep using it if they sell their home and they buy a new home. They have a certain amount of eligibility that they can keep using. It has to be owner occupied. You can't go buying a VA property and try and rent it out unless you buy a multifamily and then you can move into it and rent out the other unit. The co-borrower has got to be a spouse, right? Or another veteran. You can't have mom or dad go on a VA loan with you. It just doesn't work like that. Actually, let me take that back. You can, but then you have to put 12.5% down, which doesn't make any sense. You probably wouldn't even use your VA loan at that point. You'd probably wind up using the conventional loan. So you can have, it's called a joint VA loan where you can have somebody else on there. But again, because a VA loan is guaranteed and an FHO loan is insured, but that VA loan is guaranteed for that 25%. If you have someone that's not a veteran, they have to make up for their half of that guarantee, which is 12.5%. Short sales, there are no waiting periods. There are shorter waiting periods for foreclosures and bankruptcies with a VA loan, and there is no mortgage insurance on a VA loan. There's just a funding fee, which is pretty much the same thing. And so this is the chart for your funding fees. If you're not putting anything down, less than 5%, 2.15. If you're using it for a second time, 3.3. So there's always if you have, military members that have been around for a while, then have some money saved up, there's always that calculation to be made whether or not it makes sense to use that VA funding fee if a VA loan, if they're not exempt, because you're tacking on 3% onto the loan where you might not necessarily need to if they have money to put down. Does that make sense? So what else? Just like the FHA loan, that house has got to be in good condition. Same parameters. It's they're government loans. We call them govies. So FHA and VA pertains to both of them. However, with a VA loan, it's still mandatory to have your repairs for all your Section 1. And what Section 1 means that it's infested and there is repairs that need to be made immediately, right, to the particular home. Every house in San Diego has termites, you guys. It's kind of where we live. We have a very high infestation area. So section 1 is like immediately needs to be remedied. We have to get clearance before we close that loan. We could do it prior to funding, but we do need clearance on there. Section 2 is kind of not all of them need to be cleared. But I have seen some of them that required it. So it's not mandatory, but it's kind of it's on a case by case. It's very subjective. So it's going to depend on that appraiser underwriter whether or not they call it out that they want it done beforehand. They have to make sure that they sign off on it, that they see the appraisal, the termite report, the termite letter, and that everything is taken care of. And yeah, that's about it with termite reports, but they are required on a VA loan. So just be mindful. Okay. And it can't hurt to get a report done in advance. Because that way you know what you're looking at when you get your listing. Get that termite report. Just call out a company. The reports are free as long as you use the company to come back to you and do the work. They'll give you a free report. So make sure you do that. The last nuance I want to bring to you guys' attention is what's called non-allowable fees. And those, if a bank charges an origination fee on a VA loan, if they charge 1%, you can't have any other fees involved. And by any other fees, it includes they can't pay for appraisals or closing costs or settlement statement, doc prep, anything. Tax service fees, they can't pay for a single thing if they're charging an origination fee. And there are a lot of banks out there that will charge this fee and then try to get away with charging this, and it's not legal. So just be mindful on a VA loan if you're helping your clients look at loan estimates with your lender. You always want to make sure to call that out and ask the lender, like, do you charge an origination fee for a veteran? They'll tell you. And just like FHA, you guys, they have their own website. It's a .gov website, so don't get tricked into giving your information to somebody out there looking to market to you. This is the website to go to. I'll post both of these websites on our internal page again. But FHA and VA do require condos to be approved in advance of doing financing there. So just let us know if you have any questions and we can look it up for you. And that's it, you guys. Oh, and this is the entitlement worksheet. So just so you know, like trying to figure out whether or not somebody has any of their VA entitlement left, leave it to the government to make it a pretty complicated formula. So it's not like a really straightforward answer. It's a calculation and a half that we have to do. So that's it, you guys. That is the ins and outs that we've got for conventional FHA and VA loans. Hopefully I made you guys a little smarter and didn't confuse you guys too bad. Questions, y'all? Anybody?
Eddie, I have a question. This is Yvette.
Fire away. I know your voice a mile away.
I'm sorry. So do Movement Mortgage do non-qualified mortgages?
Yeah.
The QM, they do?
Non-QM mortgages, absolutely. Yeah.
All mortgages.
We have a gajillion amount of non-QM loans, and we actually did a class on non-QM loans last semester, and it was a great class. We brought, actually I did kind of two of them. One, I brought our jumbo / non-QM, the head of our department. She spoke about them. And then I actually brought in one of our broker partners that specialize in non-QMs, and they went through all the ones that they offered. But we can do any kind of loan that you can imagine. Yeah.
Okay, great. There's a condo that's back on the market that I did an open house for, and it's one of those condos that's going to need one of those.
Send me the info on that when you have it, please, and we'll get our condo team on it.
Yeah.
Thank you. Okay.
We've got an amazing condo team that'll do all this legwork up front for us. So if you guys have any questions about condos, let us know, and we'll definitely.
Well, especially through the VA as well. We got our condo team up front and got all the condo documentations for a condo. They submitted it to the VA for exception for us, and we're getting into escrow today for a veteran who's using subsequent use and having two VA loans at the same time. So all the things we were talking about VA wrapped up in one loan.
Yeah, we do. Wow. We do them all the time. So if you guys have any questions about stuff, please don't hesitate. Pick up the phone. Our contact information is everywhere. I'll put on my cell phone number for you guys that don't have it. Feel free to shoot me a text with your contact info, and I'll save it in my phone. But yeah, it's a pleasure, you guys. Hopefully the week goes awesome. You guys get some business. You guys find some clients out there. Let us know. Rates are coming down, so people are starting to get more and more houses on the market. People are starting to get out there and get into escrow again. So it's a breath of fresh air.
And daylight savings, they're going to be out there looking that hour later. So if you got weekdays to spare, have an open house, give us a shout.
Yep.
Awesome.
Cool, you guys.
Thank you.
Have a great week.